Hey guys, it's Dad with Dad's Guide to Adulting. I hope you're doing well and that you're having a great day. So now that we've figured out how much you can afford to pay for your car, let's talk about the process of financing your car purchase. And by financing, I basically mean taking out a loan to buy the car. Many people, including most young adults, don't have the cash in their bank accounts available to buy the car outright, pay the full purchase price outright. So what do? They borrow the money. They finance the car purchase. Now, why in the world would a bank lend you the money to buy your car? Well, the reason they do that is that's how they make money. They charge you interest on the loan, you pay them back, and they earn money because of the interest. Very, very simple, basic example. Let's say, for example, you borrowed $10,000 to purchase your car, and you agreed that 1 year from now you would pay the bank back 5% interest. Year from now, then you would pay the bank back the $10,000, their principal, plus $500, which is 5% of the $10,000, which is the interest charge. That's your cost for borrowing the money and basically their profit. And that's an oversimplified example. That's basically how it works. So where can you get a loan? Well, you can start with family members if you want, but that can be risky. If you don't pay the money back, then you've injected a business problem into a personal relationship, and that may not be something you want to do. So be cautious before you borrow money from a family member. You can also get money from banks, as we just talked about, a direct loan from a bank. And if you have an established relationship with the bank, you or your family does, with a banker, that may be a good place to start. Because they presumably know you and trust you, they might be willing to give you a better interest rate than would otherwise be the case. You might also get a loan from the car dealership where you are buying the car. In other words, you will get what is called dealer financing. You would basically agree to pay the dealer back rather than the bank over a period of time. Be cautious when you do that because sometimes dealers will charge you an extra premium for that convenience. They can end up charging you a higher interest rate. So make sure you get multiple quotes and prices before you decide to do that. So how do you find these banks and lenders if you don't know one? Well, luckily there are a number of good websites out there on the internet where you can compare rates from various different banks. You can run a Google search, for example, for comparing car loans or comparing car interest rates. You will see a number of good websites pop up that will offer you various different interest rates and deals. And you might want to go take a look at a few of those to compare prices. It is very important to make sure you get multiple quotes. You don't want to go to the first one you see. You'll get a sense for the range of interest rates being charged that month or that week. Make sure you get 2 or 3. The other thing is, once you find a lender who's offering a good rate, don't submit more than one application if you can avoid it. Try to pick the one you want and then submit the application. If you submit too many applications to lenders, you can end up undermining your own credit score. And the reason is that the credit scoring companies interpret multiple applications as you being rejected by previous lenders or you being desperate for cash. Those kinds of things send signals that you're a greater risk, and so it can reduce your credit score. You may want to ask the lender if they will do a soft credit inquiry or a soft credit check, which doesn't end up showing up on your credit report. So once you've chosen a lender, what's the process to get a loan? Well, you're going to have to submit an application. The application is going to require a good bit of your personal and financial information, and unfortunately, there are certain circumstances like this one where you do need to provide that. The lender is going to want your name, your contact information, your social security number, which they will use to run a credit check. They will probably require your driver's license or other ID, financial information such as your mortgage or your rent payments, employment information, your income, etc. Always be truthful when you are filling out those applications. They are oftentimes submitted under pains of perjury, which means you could get criminal charges if you deliberately lie on those forms. Always be truthful. You should also assume when you submit those that your employer is going to be contacted to verify your employment status. So again, be honest. You will also need a credit score. Now, we have a separate video in the financing section of our website that talks about what a credit score is and how you can improve it. But you might want to check your credit score before you submit your application for the financing of your car. That way you can find out if there are any mistakes or errors on it. For example, if some store is reporting that you didn't pay a bill that you don't owe and it's hurting your credit score, you want to know about that and fix it before you submit your application for the car. So the bank will look at your credit score, your income, your work experience, and make a decision about whether to loan to you. The lower the risk you present, the better interest rates you'll get. One good thing that you might want to consider doing is getting what's called a pre-approval letter. You get a letter from a bank which basically says that they have reviewed your credit and are comfortable loaning you a certain amount of money. That can send a signal to a dealership that you're a serious buyer, and it can help you in negotiating purchase price of your car. One thing to keep in mind is that you can also use that as a tactic. If the dealership tries to get you to pay more for a car than you want to, you can always say, I've got a pre-approval letter and I'm only approved up to 10,000 or 15,000 and I'm not going above it. It's a good tactic to use sometimes if you need that. Do keep in mind that the pre-approval letter is not necessarily a guarantee that you will get the loan. It usually means that it's preliminary approval, which has some value, but that doesn't necessarily mean you're guaranteed to get it. They also have a time limit, so keep that in mind. So once you've been approved for the loan, you're going to be asked to sign a bunch of paperwork. You'll have to sign a financing agreement and a loan agreement. This is a different contract usually from the one that you signed to actually buy the car. This is an agreement between you and the lender, you and the bank, or you and the dealership to finance the purchase. The most important part of that for you is the Truth in Lending Act statement. You're going to want to look for that. It's usually a page or two, and it contains the key basic terms of the loan. It'll have the amount, obviously the most important number, the interest rate, which you're going to want to check. And one important thing about the interest rate is you may have negotiated a certain interest rate. You're going to want to make sure that's the right interest rate. But there may also be something on there called the APR, which is the annual percentage rate. That is usually going to be a different number from the interest rate because it also includes fees that you finance in the purchase, so it may be a little bit different. You're also going to look at the term of the loan, how long it goes for. You want to make sure it's the amount you agreed to. And remember, as we talked about in the budgeting video, don't agree to a term that's longer than you wanted because that means you're paying more for the purchase price of the car. You also are going to want to check the loan document to make sure that there is no prepayment penalty. In other words, if you decide to pay off the loan, or the note as it's called, the promissory note, in full early, you can do that without having to pay a penalty. That would happen if, for example, you decide to buy another car before you fully paid off this car and you want to pay it off. You may just decide you want to pay it off and stop paying the interest. You want to make sure there's no penalty for doing that. Also check to see what it says about insurance. The lender will usually require you to have auto insurance on the car, and sometimes they will require you to name the lender on the auto insurance policy so that they get paid if there's an accident. When you finance the car, one of the things you need to know is that the lender will place a lien on your car. That is spelled L-I-E-N. It's an odd word, but basically it means that it's something that appears on your title, on your certificate of title, your ownership document for the car, and confirms that you owe them money. That protects them because you can't sell the car without clearing it of the lien and paying the bank first. Those documents go on file with the county registrar or whoever in the state is responsible for registering motor vehicles. So how is the loan paid off? Well, you're going to pay it off in monthly payments. And one of the mistakes that people sometimes make early on is they forget to make the first couple monthly payments because they haven't figured out exactly how they're going to make the payments. Is it electronic? Is it automatically withdrawn from your checking account? Are you going to be getting an invoice? Is it your responsibility to know what the due dates are? Check on all that early on so you don't miss your first couple payments and end up hurting your credit score. The loan that you get is probably also going to be amortizing. That's not something you really need to know, but it's helpful to understand. You're going to be paying the same amount every month. In the early stages of the loan, most of what you pay is going to go to interest because you owe a lot more in principal, so the interest is higher. In the latter stages of the loan, most of what you pay is going to go towards paying down the principal rather than interest. Not something you really need to know, but if you hear the term amortizing or amortization, that's all that really means. Finally, when you pay off the loan, the lender will release the lien that we talked about earlier. They will notify the state or county motor vehicles department or whoever registers cars in your state that the loan has been paid in full. The state or county will then issue you a clean certificate of title that no longer shows that lien, which means you can sell the car without having to deal with the bank. So that's our video on financing. Until next time, remember, you got this.